Good evening, everyone. Welcome to our little share update. So just a little bit of feedback. Over the last 3 months, we've been trying to build our complement of traders. So we've got two new guys that are going to be helping on the share side of things. So my main focus has been artificial intelligence and cloud, artificial intelligence and the metaverse and that kind of stuff. And the other two guys can kind of watch whichever markets interest them. And we're hoping to at the end of the day push out between 2 and 3 trades a week between the four of us. So we're going to be including currencies very soon, and then the other two share traders. So just to give you a little bit of feedback on what I look at, just to get started. So Rob has been kind enough to start putting this data into official formats for me. I like to use a P/E ratio as a guide to which shares I want to be interested in, or which shares I should be interested in. And it works on an oversold basis, overbought basis. So when is a share cheap, when is it expensive? And what we've got here is we've just got one standard deviation outside of the P/E ratio. And you can see when we made the first call on Google, this is just Google's, that was in September last year, and you can see the P/E ratio is down below the 18, below the 20 mark there. And then in November, October, end of October last year, same sort of thing below the 19 mark. It was about 18.6, I think. And then we had another opportunity in December, and then Google's price took off, and the P/E ratio moves with it. As earnings come out, then the P/E ratio tends to drop if earnings are good. And that's just basically what I'm looking at to identify cheap or expensive. Now, what that leaves us with is, sorry guys, just give me a second here. There's guys trying to get in. There we go. All right, so that's just a guideline. All right, so when I say I consider a share to be cheap or expensive, that's basically what I'm looking at. Obviously, there's a lot more of that research that goes into a trade, but this is just a quick way to identify things. And when I say cheap or expensive, this is basically what I'm referring to. And then before we get onto the actual shares, this is an update of about 10 minutes ago from the market. So if you've been watching the NASDAQ, you've seen the index fall quite hard. And what I wanted to look at here quickly is just to show that an index is not the be all and end all of share trading. So shares move on their own, they're their own entity. And just because the index is falling doesn't mean all your shares are falling. So if we have a look here, for instance, NVIDIA shot the lights out yesterday with their results, 189% increase in earnings, which is pretty heavy, and the share's only up 7%. Well, 400 Rand share, I see some people are calling that to 1,100 Rand. Now, the problem with that is NVIDIA's P/E ratio is very high. So if I quickly pull up NVIDIA, where are you? There we go. And we have a look at NVIDIA's fundamentals. So yeah, their results are great, but what is their valuation in comparison to other shares in their sector? All right, so there's NVIDIA, and their P/E ratio is still 208. So that's 208 years of earnings to get to the current share price. It doesn't mean you can't trade it. Just for myself, who wants to hold these shares, as long as possible. Some of these trades can be held for 2 or 3 years. Some of them even longer than that. Doesn't mean you can't trade NVIDIA short term. It's just not my personal goal. One of the other two guys might start looking at that type of trading, but then we're going to specify, this is a short-term trade. We're expecting NVIDIA to go from here to here, take our profit and walk away. Similar to what I've been doing on the longer term stuff is we try and buy it as cheap as possible and hold that first entry, and then build that position up to a point, take some profits, build some cash up for the next entry. So NVIDIA doesn't fall into that category at this point. So even though their earnings are fantastic, they're still very expensive. And I'm not really prepared to add that into my long-term portfolio at those valuations. All right, so just that little bit of feedback there, and the P/E ratio is a nice little guide to decide when a share is cheap or expensive. Okay, let me just stop this thing here. It's going to slow down everything. Come on. Sorry, I try to get this updated. So that is the latest share price for NVIDIA, 479. You can see the big gap up at open to the 500 mark, and now trading below 480. So yeah, the market also deeming it to be a little bit overbought, and it's been a pretty hot stock. So let's just start at the beginning. We'll have a look at Apple. And so all these shares are identified based on the AI idea and metaverse and so on. And then I use technicals to make trading decisions. So Apple at this point is up at a P ratio of 30. So it's gotten to the expensive part of the market. And it's at a P of 30, even though it's dropped from that 195 down to 175, currently trading at 178. Now, what I'm looking for is that P to come below 29. I'm looking for about 28 for the first entry. And I've got that support level there at 170. And that's that 38% retracement, swing low there to current swing high. And so 170 is the first area of interest. Now, I don't just put an order in at 170. If I was going to put an order in the market, it would be down at 140. So that's my ultimate buying level. It'll push the PE back below 20. And then that makes Apple pretty cheap, even historically speaking. So the current downside target, 170. If it breaks through that and pulls back above 170, that's what I'm going to call as an entry. So I just wait for the market to actually tell me what's going on. If it consolidates below the 38% level, even better. Looking for the breakout trade. If it continues lower, I've got the 50% mark, preferably down to 61.8. On a fib basis, that's usually a pretty good place to look for the end of a retracement. So we have the main trend up there, hopefully an ABC down, and my target is that 61.8% level, and that's where I'm looking to enter Apple. Obviously, if you're part of the Fib Strategist Signal group, then as those trade orders go into the market, they'll get popped into the Telegram group. All right, so Apple, that's what I'm looking at there. If it does move higher, I'm not going to chase it. I don't like chasing expensive stocks. I prefer to just wait for that price to come off and hold on to the cash. Then we look at AMAT, Applied Materials, and they're sitting at that 261 extension. So that's a little ABC there. That's a super extended C wave, and it's just looking, it's looking well overbought. Yet it's still on a P of 18. Now, that looks cheap when compared to Apple, but it's expensive compared to AMAT's history. So Applied Materials history, their P ratio is normally at around 16 is looking interesting. So at this point, AMAT on a technical basis at resistance, buying levels down at the 130 mark there. It'll push that P ratio back down to about 16.5, and then ultimately down to the previous breakout area. And that price, if this thing would cooperate with me, come on. There we go. 117.20. So if I was going to put an order in on AMAT, it would be right down at the 0 mark there, which is just above 90, 94, 95. I haven't done that yet. I want to see what happens first. And so initial support at the 130 mark, then down to the previous breakout level. And obviously each one of these fib levels offers a different opportunity. If it does find strong support on that 127, I'll have a look at buying that on a turn. AMD, so AMD has been sold off quite heavily today, and you can see this is exactly what I'm talking about. So my first level of interest was at that 103 area, and today we're back below it. So there was a little gap down at the open on that day, on the 18th, gap down, closed above it, and I've got a few queries as to whether I should be buying into AMD or not. My answer is really simple. Well, that's not a very good buy signal. At this point, maybe a break above resistance or something like that. I don't want to get too technical here, but the risk is always that that is the initial support level, and I am looking for that to push back down to around the 80 mark. Little accumulation zone going on there below 61.8. So that accumulation, it's also the price support level, and that to me is more important at this moment than the 61.8. But if price does find support there, it'll be reasonably clear, and I might have to just take a slightly more expensive trade. There won't be much on the P ratio there. And ultimately down at the 88.6 level, which is that previous price support, 62.45. Now, if we look at AMD's fundamentals, PE of 55, it's very expensive, even though it has dropped from those highs above 130 to 102. So it's 30% down from the highs, and it's still expensive. And that's why it hasn't made it onto the new trade list. So looking for that 80 or even down as far as that 60, 65 level. Now, most of these companies are in some way related to AI. Alibaba, Chinese company, online retail, Chinese competition to Amazon. I haven't got Amazon on my list because they're just too expensive on a PE basis. If we have a look at Alibaba, they're trading on a PE of 11, which is pretty cheap for the sector. Now, they use AI within their business model. So they're users of AI rather than creators of AI. And if you've ever shopped in Alibaba, you would have seen it in action. It's a little bit more fluid and free-flowing than we would be used to on Takealot, for instance. And the search works better. And it's way cheaper than Amazon. Now, obviously, there's risks with buying into Chinese companies. If the government there decides Alibaba's upset the government, then they can shut their doors, basically. So there's always a bit of risk with that. And it just wouldn't be, a massive part of a portfolio. Maybe 1% or 2% of a portfolio rather than 5 or 7%. Ultimately, I'm looking for it to push back to 77. That zero line there, price support, the little accumulation zone. You can see my other buy level at 82.76. So I'm not chasing that on the way up. I am looking to buy it down on one of those two support levels. And of course, if it does continue to move lower, then I'll just wait for the bounce. Cisco, so Cisco on a discounted cash flow basis is valued at about 60 to 65. Currently trading at 55, so there's still 10 Rand a share to go there. I think if you don't know, on Cloud Trade, these numbers are in rands. In reality, in the US market, they're in dollars, so we don't face the exchange rate risk that you would if you were trading in the States. Trade Nation offer that as a 55 Rand a share. So trading at 55 there, that breakout looking pretty solid. The trend is up, short-term trend is up there. We can see the 8 pulling away from the 21 pulling away from the 89. So kind of getting to potentially short-term overbought levels. But the target for that up at the doubling mark, and that's just basically that little swing there, and that's the 200% extension. And that's what I'm looking for. And that trade, I didn't put a target in on the actual trade because obviously it can push through the 200 and 261.8. But at around 60, I'm going to start trailing the stop loss closer. For now, it's still on the lows around 46. I'm not going to be rushing it. If it does hit the 60 mark, I'll get that trailing stop loss up to the 161.8 there, so just below 58. But for now, that's looking pretty solid. And always remember, this is just like a little overview. It's what I've been looking at. As the other guys come on board and start putting out shares, they'll also get a chance to speak about them. So just basically a technical overview. When you do see the trades coming through, you'll know that it's more than just a thumb suck or a guess. We do put quite a lot of work into it, and that is why it takes us so long between videos to update all the fundamental stuff. Okay, I just want to get this a bit smaller. So there's Google. Google, you can see when we looked at the P ratio, that was the end of September. And if you remember correctly, I don't know, okay, most of you wouldn't have been on at that point, but the guys that were on, we did take a trade there, and we did get stopped out on the break of that low. And then Google bottomed out, and I just waited for the bounce to come through. We got long around here somewhere, and then as it failed to hold on to that, we exited. little double bottom, and we took the long again. So just above those lows, just a little internal shelf there at just above 90 Rand. And since then, we're still holding that initial position. I can't remember offhand where we entered. Actually, I can pull up that spreadsheet. We can have a look at it. Got it here somewhere. There we go. So these are the current trades. So those are all the open trades, closed positions. We can just see Alphabet in there. And that trade 109 and then closing at 118. So it was a little bit of a shorter term trade. Didn't go all the way, which is fine. That happens sometimes. So 118 got a little bit early after that run up. But again, it was a trade. The initial position is still in play. And that will just hopefully stay in play for some time. If we zoom out a little bit, we can see the next target for me is up at that 261.8. What I am hoping for is some form of retracement before we enter the December period. All these stocks tend to do well over December into the new year. So you can just see Google there, December into the new year, then another retracement. So hoping for that to just pull back. You can see my two alerts there. And at that 127 extension at 113 and then 108. So either one of those two levels, if it does offer support, you'll see a trade trigger coming through. If it really gets down to 95, that's going to be a long-term buy signal. And I think, that'll push the PE ratio back below 16, if I remember correctly. For now, a little bit on the expensive side, up at 27. And if you just remember what we looked at here, they were cheap below 20. So at this point, Google's still a bit expensive on the fundamental side. But of course, Google is Google, one of the biggest companies in the world, and they should continue forward with their AI, DeepMind, and all that kind of stuff that they've got going on. Lots of AI stuff in Google. If you've ever used Google for your business and you've had a look around there, you can see lots of AI apps coming through now. All right, so IBM, now IBM is a much longer term view than the other shares. If you are a little bit more aggressive and you wanted to trade these swings, it can be done, of course. I'm looking to build a position in IBM. We've got 3 positions open on the signal service. We've got 3 IBM positions open. So it leaves me with a little dilemma, because I don't really want to add a 4th for myself, but there's obviously a lot of you who have not got an IBM trade open. So I'm still trying to figure a way around that. I might just add it in there anyway and take a 4th trade. But I'd like IBM to come off a little bit more before doing that. Their fundamentals, they're also big on cloud trading, servers, cloud servers, and all that kind of stuff. So that's what I'm looking for. If there is ever a metaverse created, their servers will more than likely be used for that. If not, plenty of businesses are using the IBM servers for their cloud computing. And obviously, they also run quite a serious AI in the background there. So just remember, not all AI is available to us. ChatGPT is just a language model. So it's not true artificial intelligence. It's basically something that can really just pull data out of the web. So it's not a learning machine. IBM are working on learning machines. Google is working on learning machines. So is Microsoft. So is Apple in a slightly different way. But anyway, so IBM P of 15 is neither cheap nor expensive. It's pretty much fair for IBM. But their share price is looking pretty solid. We've got some good entries in there. At 158, I'm going to look at taking some of those profits. And from 143 to 158, that's a reasonable return if you're a short-term trader. 8 and 21 did cross up, and that has confirmed today. I haven't decided yet if I'm going to put it through, but if I do, you'll see it go in tomorrow. If it doesn't go in tomorrow, then I'm not buying at these levels. Then we've got Intel also. So Intel is a bit of a longer term high risk trade. High risk in that it is currently very expensive. It wasn't when we started trading it, but they're spending a lot of money on building 2 new big mega factories. to improve or lessen their reliance on Taiwan Semiconductors, again, a Chinese company. So they're building 2 mega factories themselves, and that is using up a lot of their cash. So their PE ratios jumped, I think it was 18, 19, somewhere there, now sitting at 76 after their last results. So they are using a lot of their cash to try and grow the business. The view on this one is 5 to 7 years from now. When I started trading, it was 8 years. So 5 to 7 years now, and looking for the next breakout. If it does get back below 30, or even down to the current low there, 27, I'll be looking to pop that in there as an add-in. Or even for those who don't have it, I don't have a big enough position in Intel yet. I've only got one trade going there. I'm looking to build 2 or 3 positions like I have in IBM, and then wait. IBM pays out decent dividends. Those dividends help pay for the swaps. So dividends do come into it. I haven't mentioned that yet. But let's just finish up with Intel. So Intel technically not looking great. You know, this kind of action where previous highs are broken and previous lows are below the previous highs and so on. They're called zigzag patterns, not a trend, in other words. So even though there's higher lows, it's really not a trend. It has to be, these lows have to be above the previous highs for it to be a trend. So for now, that is still considered by me to be in consolidation. If we have a quick look at IBM, their dividends play a big role, currently at a yield of 4.7%. IBM is valuable when its dividend yield is greater than 5, which it was a few weeks back or a few months ago. Now 4.7, as the price goes up, the yield will decrease. But as soon as that gets to a 5% or better dividend yield, it just helps pay for the swaps and all my other trades. So the 3 IBM positions have paid all my swaps for the rest of this year. Well, for the whole year, all holding fees being paid for by the IBM divvies. As Intel's dividend used to be good, 5%, it's now 1%. Again, they're spending all their cash on growing their business. All right, so Meta. Those of you who've been on the Signals group for a while, we kind of messed up a little bit on Meta. I certainly didn't expect this trend, from 90 Rand there all the way up to 320. We only caught portions of it, so I think we caught that little trade up there, and then got stopped out, and then we caught a little bit over here and got stopped out again, and we didn't catch the whole thing. It was just one of those surprises. Done at these lows, Meta was very iffy. You can see their results came out there. It was a big drop off. They lost 30% down on advertising income. Now, if you look at a company like Meta and Google, they are both advertising businesses. That's where they generate most of their income. So if they lose advertisers, then they're losing money. So at that stage, Meta was looking very painful. And then they just continued to surprise to the upside. And all one had to do in hindsight was 821 crossover and just hold until it crossed down again. So at this point, I am looking for Meta to get back below 240. They again expensive at 27. And down at 240, they'll be a little bit more, a little bit cheaper than they are now, about 20, 21, 22, somewhere there. Ultimately 200. If they get down to 200, I'll be quite happy to buy in there, and of course lower down below 160, then that would be a major position starting point. So from 200, I wouldn't mind like a medium-term position there, maybe the next 12 months. But down at 160, I certainly like to hold that for a lot longer. So at this point, nothing really to talk about on Meta. They still haven't broken their previous high. So there's still space for that to head through 380. And again, when they get expensive like this, I'm not really keen to just jump in there and hope for the best. I'm quite happy to just be patient and wait for the drop. All right, so Microsoft coming through, and that's another one that we kind of missed. Look, you can't catch every trade. And Microsoft and Meta were the 2 sad ones this year. We caught a piece of the trend, but we didn't catch the whole thing. And since then, Microsoft from that 360 all the way down to 310. It just touched my buying level there. I would have preferred to buy it below that, and it didn't break through. But Microsoft also reasonably expensive on a P of 32, 33, and no real dividends to speak of. My preferable buy areas below the 280 mark there, that accumulation zone. You can see the little green line there, 61.8% retracement, and that's down at 275.48. I'd be quite keen to pick up some there. If it ever does get back down to 220, I'll be over the moon to buy back in there. Yeah, these massive companies are really, they really geared up for that whole AI metaverse type idea. Quantum computing comes into it as well. I haven't even touched on that. Yeah, these are the guys that are really, really going to benefit from all of that. They're just positioned to do so. Microsoft buying out the ChatGPT, what is it, OpenAI? That was a very clever move from them. But as I said earlier, it's not true AI. It's basically just a chatbot so it can find information. But the true AI is still being used. Google's got probably the best AI model at the moment with learning computers, and those learning computers are helping them create quantum computers. So it's getting really, really hot under the collar there. Micron's come off my watch list. I still have some positions open on Micron. They are losing money, so their P ratio at 0. I pay out a tiny little dividend there. It's not worth talking about. Look, these guys are geared up. If it does come down through the 60 mark, or even down to the previous lows there, 52, 49, those areas, then I'll put it back in the for the signals group. They're also positioned to take advantage of that. If you have a look at their business, DRAM, okay, flash memory, all that kind of stuff. So their memory business, to run those kind of things, you're going to need massive memory. Western Digital was also on the list at some point. I've taken them off as well. Their latest products are just terrible. Their hard drives are just failing for no reason after 3 months of being in the machine. So until they've sorted that out, I've taken them off that watch list. And Micron's kind of dawdling along as well and not performing at this point. But don't worry, I keep an eye on these companies every week. I go through their updates and speak to people. All right, so NVIDIA, we went through earlier. There's nothing really there. I mean, that share price has to drop off by 50% before I even look at it. Then we've got Qualcomm. If you have a look at Qualcomm, they're reasonably cheap at 14. If you have a look at their chart here, you can just see that base is pretty strong there. 2 accumulation zones. So back down at 105, that sort of area, I'm looking to get some more Qualcomms. They're reasonably cheap on that P of 14. And they also supply into the whole AI market. So I'm quite keen to just get another position into Qualcomm. We were stopped out of that earlier this year. So I'm looking for another entry there. If it does break back through that buy level 113.50, maybe just a little nibble. Just remember, when I do put out the calls, I do make comments as to whether it's high risk, medium risk, low risk, or what the risks are and all of that. So please, guys, just remember to watch your sizes. If you trade a mini contract with Trade Nation, that mini contract, a position size of 1 is equal to 10 shares. If you trade a standard contract, a position size of 1 is equal to 100 shares. If you need any help, I mean, you all know how to get hold of me, so you're welcome to ask. So then we've got Tesla. Now, obviously, Tesla doesn't really fit into the general idea here, except that they do use artificial intelligence. They're a testing board for software, hardware, all sorts of things like that. They don't they don't create their own processors and that. They've got to buy that in. So very much a test bed and very expensive. So Tesla at 66, the big thing about Tesla is really their battery, the battery division. So as they create better batteries, that technology feeds into the rest of the market for all sorts of things, especially here in South Africa with load shedding and so on. Their advances in batteries do definitely push through. I don't see them as a motor vehicle company. I see them as a technology company. Now, on a P of 66, that's after dropping from 300 to 230. They're still very expensive, and that's why Tesla was just a trade. I haven't built an investment position here. I'm just looking to trade it. Some of the swings, get some of the just get some of these upswings. If it does happen to take off, I would expect that I'd be in it if it does take off on a run. So yeah, of interest down at 61.8, purely a technical level, 208.37, and then that support down at 150.160. So Tesla would be a shorter term trade. It'll have targets in there, or even a tight trailing stop. Not everything has targets. I prefer to trail my stops up and get more of the trend out of each position. So that's the main idea. Those are my main stocks. The other two guys will start pushing their stuff through soon enough, and we hopefully will get some more triggers going through. The one thing I have learned is become a specialist at something. On shares, for instance, for me, it's more the fib levels and 3 moving averages and some basic fundamentals, and then obviously have an interest. So the stocks I'm interested in, artificial intelligence, not because I particularly like computers, but more I like to invest in companies that I expect to do well for the next 30, 40, 50 years. Then it's very difficult to go wrong with the bigger guys. And the smaller companies basically is to just assume some risk, because Intel has the capacity over the next 3 to 5 years to easily double, triple, or even 10 times their current share price. The same for IBM and Applied Materials, same idea. Apple's not going to triple from here. Okay, I mean, they got it's a massive business. For them to triple, probably not going to happen in 3 years, but certainly over the next 15 years, I would expect Apple, Google, Microsoft just to continue to pump out those 20, 30% returns per year. If you have any questions, you're welcome to type them into the chat group, the little meeting chat. Or if you really want to, you can turn on your microphone and ask a question. Yeah, nothing. All right, guys. Well, I mean, you all know how to get a hold of me if you do have questions going forward. And hopefully some of these shares drop off enough to give us some buy signals, and we can get going again. Probably not this week, but next week. Hopefully these prices come off a bit and we can start rebuilding that portfolio. All right, well, trade safely, careful of your position sizing. If you're in doubt, just ask the question and I'm happy to walk you through it. All right, thanks for listening, and I'll chat to you again in another few weeks' time.